Just when you thought central banks have managed to put a lid on inflation, fears have resurfaced. What's your own assessment of the impact on the global economy as well as Singapore's economy?
Yes, so I think if we look back, say, a year and compare to what is going on now, I think generally you have to accept that inflation has come down without excessive cost on the real economy and on unemployment. I think many of us, including myself, thought that as central banks tightened monetary policy, and this is the most rapid pace of tightening in decades, that economies would necessarily have to tip into recession in order to purge out price pressures. So I wouldn't rule out the risk. I think the risk remains on the horizon, but at least now we can see, we can imagine a pathway to lower inflation without necessarily having a recession, which I think a year ago we were less sure about.
You surprised the market this month when you announced a tweak in the frequency of your meetings. Is that in response to all these uncertainties you're talking about? I mean, what's the thinking? Why now?
As you know, I think in just the last 2 years, we've had to make a few off-cycle moves. Now, if you do an off-cycle move in response to quickly changing developments, say once in 10 years, I think that's okay. Markets understand. Sometimes you just have to move out of cycle. But if it becomes too frequent, then I think it just sets off apprehension. This does not mean we are moving towards a shorter term orientation in monetary policy. It's always been a medium term orientation. So that was one of the reasons why we hesitated in the past moving to a quarterly cycle. There's
been so much volatility in the markets, and we're seeing massive movements, especially in the bond space. 10-year yields hit 5% for the first time since 2007. I mean, how are you looking at where yields are right now and how high they have gone in such a short period of time?
Again, we should not forget the good news, which is that, well, they did not blow up into something bigger. The problems were contained, largely because I think at least the banking system is quite resilient against the kinds of interest rates increases we've seen. Some corporates are not, some households are not. But by and large, I think we've managed this transition to higher yields.
How about the risk from the BOJ? Some central banks have said that perhaps when it makes an exit from YCC or its zero rate policy, that might cause a lot of volatility.
Again, we should be thankful that the monetary policy tightening and the removal of quantitative easing has not been too synchronized. Because if it happened at the same pace and scale in the US, in the EU, and in Japan, I think the impact on the world would be much, much bigger. Thankfully, they're all at different points in the cycle. Their responses have been slightly different. The US taking the hardest position in terms of removal of QE, followed by the ECB, and now Japan is doing the same. So I think this sequencing, not by design, but each central bank responding to its domestic situation, has not been too bad.
Of course, we've seen gyrations in the FX space. The Sing dollar, I mean, for the longest time this year, it's been pretty stable against the USD, now perhaps weakening. Are you comfortable with the movements in the Sing dollar?
Well, we've never been bothered by bilateral exchange rate movements. Almost all currencies have depreciated or weakened against the US dollar, partly reflecting US monetary policy and the strength of the US economy. So I think that's in itself not a concern. But when you look at the trade-weighted exchange rate against all other currencies, the Singapore dollar continues to appreciate. So monetary policy remains appropriately tight, and it has managed to bring down inflation from 5.5% or so core inflation down to now the latest number is 3%. We're heading towards 2.5 to 3% by the end of the year. So its mission is not accomplished yet, but it's on track.